Wall Street Week with Louis Rukeyser is made possible by the Corporation for Public Broadcasting and by the financial support of viewers like you. By the travelers, over 40 million Americans benefit from our insurance investment services and managed health care. The travelers. By Financial Guarantee Insurance Company, helping to provide investor security, FGIC AAA Municipal Bond Insurance, tomorrow's security. And by Prudential Securities, the knowledge and resources you need to help make intelligent investments. Rock solid, market-wise. Produced Friday, October 11. Our panelists are Ralph Acampora, Gail Dudak, and Martin Zweig. Tonight's special guest is Mark Leibovit, editor and publisher, The Volume Reversal Survey.
Good evening. I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, I don't know what went on between Clarence Thomas and Anita Hill, but I do know that this American economy was clearly subjected to harassment this week. And I think we should all get together and figure out where to lodge a protest. There were, first of all those nasty pictures we were forced to look at. I mean, have you ever seen such disgusting charts? If this economy isn't rated XXX, what is? Even a nice, respectable girl like Nordstrom shocked jaded Wall Streeters when she took the wraps off her disappointing third-quarter earnings. Decent folks shouldn't be subjected to stuff like that. Then we were told the plot of a genuinely pornographic, not to mention downright incredible movie, in which a bunch of weirdos dressed up as the nation's economists kept insisting that the recession ended last spring, while masses of innocent, ordinary folks wondered what pervert had been writing their scripts. There was also a lot of dubious talk about size. The size of the consumer's enthusiasm seemed considerably smaller than advertised, for example, as a disappointing report on retail sales graphically demonstrated. And inflation no longer even seemed to belong on a large screen. Producer prices, again, barely budged. Food prices were actually down, and those fretting about a near-term return of double-digit inflation seemed even more miscast than usual. Then there were all those unwanted moves on the part of the bond market, which thinks it's so sophisticated, but proved its basic immaturity by hurtling down and then hurtling up on successive days with absolutely no intervening news of significance, thereby demonstrating that the only thing sillier than a senator as a moral judge is a professor arguing the efficient market theory or a bond trader pretending to be a grown-up. We tonight will get down to truly significant matters, like how reliable are our elves, as we deliver their annual report card and talk with one of the ablest of the little chaps. But first, let's see who was harassing whom in Wall Street in the week just passed. And as the Dow Jones Industrial Average indicates, stock traders continued to fret both about the weak economy and about the Federal Reserve's apparent reluctance to push a further easing of monetary policy. In the end, the blue chip index reversed a two-week decline by gaining just under 22 points to 2983.68. But the broader market failed to share the advance, with only the S&P 500 edging into the plus column. And our elves lost a notch, too, as Chief Elf Alan Shaw joined Stan Weinstein in minus territory, bringing the consensus of the 10 top technicians on the market's next 6 months to outright neutral. Bonds ended the week down about half a point after a major comeback on Friday, while precious metals were mixed and the dollar was a little stronger. And if you're wondering just how nosy your neighbors and friends are, a new book reports on a survey of more than 3,000 Americans, purporting to show that almost half peek in the medicine cabinet when paying a visit. Heck, folks, hardly anybody keeps the videotapes there. Marty Zweig, what do you think of the market tape?
The tape itself hasn't been acting very well. Even this week in the rally, the breadth wasn't particularly good and the volume wasn't good. So I would rate the tape moderately negative, or perhaps neutral at best.
You think the monetary factors are still positive, though?
Monetary, which gets the most weight in my own models, is still bullish, although it was disconcerting that the Federal Reserve drained reserves 3 days in a row this week.
We should explain what that means.
That's what I'm trying to do now. The Fed funds rate has been targeted at about 5.25%, and when it got down close to 5, they drained reserves so that the so the Fed funds rate wouldn't go any lower, even though they're not trying to raise rates. But it's disconcerting because they're draining reserves from the system, and that's not good for the economy.
Why would the Fed not want interest rates to go lower?
That's usually the way they maneuver, and I don't think it's a good way to do it. I would prefer that they target reserves rather than interest rates, but they can't control everything. On the other hand, most people say this is only technical. There's a holiday Monday. It may not matter.
Do you think the Fed's afraid of inflation?
No. I think they have been, but I don't think they are now. I hope they're afraid of the economy because that's the bigger risk.
You're neutral in our Elves index.
Right.
Does that mean you're taking some money off the table?
Not really. I'm not quite as positive as I was a couple weeks ago, but I'm still positive on the market, but not quite enough so that 6 months down the road on the Elves, I'm not that confident we'll be up more than 100 points, but I do think the market has an upward bias.
Gail Dudak, this is Elves Night Out, as you know. Everyone here on the panel is one of our chief elves. You, however, have the distinction of being the only one here tonight who is bullish on the next 6 months. You and Laszlo Barini are only two outright positive elves. Why are you enthusiastic when the others are so wary?
Well, because I think everyone's focused on the negatives. And I think the market is a discounting mechanism. And with all this focus on all the negatives, and I'm not saying there aren't some, there are plenty, but I think they've been discounted. And in fact, in this week's market action, I think a lot of negatives are being discounted. And so I think the next big move is up.
Does your technical analysis encompass a belief that the economy will be better?
Yes, but it's really based on the fact that interest rates are headed lower. I think that one of the reasons to be optimistic on the economy longer term is that inflation, which has really been a problem for the last 20 years, I don't think is going to be a problem for the next few years, and that means that interest rates can fall further than people expect, and that will have very positive effects on a fairly anemic economy.
Since you're the biggest bull here tonight, why don't you tell us what you'd be buying these days?
Well, right, I think we're in the process of having a lot of pretty big, sharp declines in a lot of stocks. So I think there are lots of things that are getting attractive, but I've been focusing right now on utility stocks and the rail stocks. As particularly the utility stocks, I think, which yield much more than money market funds, and I think will benefit by the fall in interest rates, and then will also benefit by the improving economy next year. It's a much better place than being in cash. You can get 7.5% dividend return in a number of very good electric utilities.
Okay, Ralph Hackenpura, up to last month, you were one of the bulls. Then you moved your vote down to neutral. What made you a little more cautious?
Lou, I was looking for a summer rally to carry to around 31, 3,200. And for me to do that, I not only need the market indicators to confirm that, but I need some stocks. And Marty was talking about the narrowness of the breadth. And when I started losing Bethlehem Steel, American Telephone, American Express, and DuPont, and a few of the other Dow stocks, I just don't think we have the strength to make it up to 31, 3,200. I agree we can get a rally from here, but unless it's on broad-based participation, I think it's just going to be short-lived.
Does the fact that it's October and we've had some sharp sell-offs in October have any significance to this market?
I think emotionally probably it does, but not my work. I don't. There are seasonal factors in the market, but I didn't pull my positive rating because it was October. I pulled it because I saw some internal deterioration. I think the perverse thing would be is that the market holds in October and you maybe have your decline in November.
Just when everybody's looking for it in October.
Exactly.
When you talk about market breadth, you mean that there aren't enough stocks advancing every day? The volume is not enthusiastic?
Well, just the other day, the Dow was up 30 points, and you had more declines than advances. So if you had any advances, it was very, very narrow. That's what we're talking about. It's you need the participation.
How sharp a sell-off do you think we might have?
Well, I've been looking for a correction. For me, a correction is somewhere in the neighborhood of 8 to 10, maybe even 12% from the high.
And we've had some of that already.
Yes.
All righty, at any event, panelists, it is time now to answer one of the deepest and most significant questions of our times. Namely, how can our viewers make a few bucks? Marty's wife, Robert Luther of Stony Brook, New York, suspects he is a victim of unfair pricing of zero-coupon treasury bonds, those securities that pay out no annual interest but are worth $1,000 when they mature. As he puts it, while our attention has been focused on the illegal bidding for treasury bills and bonds, I believe a greater investor trap lies in the rigging of zero-coupon treasuries by our major brokerage houses. When he sold some of those bonds recently, the price he received was more than 1.25 points less than the bid price listed in the newspapers. His broker told him those prices apply only to lots of at least $1 million. He wonders whether he's getting ripped off by the brokerage, and he also wonders what a reasonable price for smaller lots would be.
He's not being ripped off, and there's no rigging going on. He was trading in a small lot, and the round lots really are $1 million. The markets tend to be illiquid, and the spreads seem high, but actually his spread was lower than some I've seen quoted. I don't think he was ripped off. If he wants to trade them, though, it's obviously not economic to do it in small quantities. Then he should buy a mutual fund that specializes in zero coupons, and it would be more economic for him.
Well, you say that his was less than many a spread. What is fairly typical then for small?
Well, in researching this, I found spreads as much as 2.5 or 3%, possibly. It depends on the bond.
Tough one for a little guy to trade, huh?
It's usually tough to trade in small amounts in anything.
Gail Dudak, how would you respond to Gordon Horn of Daytona Beach, Florida, who writes me as follows? I've been reading some annual reports. So what's goodwill? Where does it come from? What does it look like? Who decides how much it's worth? And can it be cashed in for real money? Also, can I get some, and will it raise my credit limit?
Well, he's been reading annual reports, and that's the giveaway here is that in a balance sheet, if he's read an annual report and there's goodwill in the balance sheet, he must have been reading the report of a company that recently purchased another company. Because goodwill is an accounting term. It's the difference between the purchasing price of a company and the value of that company's identifiable assets, less any other liabilities they've incurred. Now, how do you get goodwill? Obviously, the best way to explain is let's look at Coca-Cola versus a generic cola company. Coke has a lot of goodwill. That is, how do people feel about Coca-Cola? That company might be just a building, but it's worth more than generic Coke. Can he get some? Well, I think by watching the show, he's getting some, don't you?
Well, you certainly have a great deal of goodwill in our books.
In our books, you do.
Absolutely, all of you do. Ralph Akampora Adam Brady of Grosse Pointe Shores, Michigan, says when he asked his father for some investing advice, his father said, ask Louis Rukeyser. I have a better idea. Let's ask Ralph Akampora. The current wave of being earth-friendly, Adam writes, has presented in my eyes a golden opportunity for a wise investor to not only help save the planet, but make some serious green as well. I feel that recycling within the next 10 years will become mandatory nationwide. What companies are heavily involved, or soon could be heavily involved, in the recycling movement that could be profitable, whether it be companies that transport, process, or distribute recyclable material. I hope that with your help, I can make the future better, both financially and ecologically.
Lou, these companies are called socially responsible companies. One that comes quickly to mind is Wellman. It's a very large producer of carpets and fibers and apparel material. And to think about that, maybe our clothes are made out of old plastic cans and our carpets are made out of old glass material. But that's what's happening. 50% of their fibers is waste material. Safety Clean is another company that takes care of hazardous waste. The oil in your automobile is being re-refined. The dry cleaner that you use, his material is being re-refined. But the one company that really interests me is a little thing called Carlisle Plastics. And these people make plastic bags. And 50% of the plastic bags is not plastic. And the waste material used, only 15% of that is actual plastic. So it's economically friendly, and it's cheaper for the consumer.
Do you always separate the good advice from the bad before you put out your garbage?
Absolutely.
All right. Now, if you're interested in cleaning up one way or another, and preferably both, we will try to help you do well while doing good. Together, fellow idealists, we may make this world greener, starting with your bank account. So breathe deeply, think nothing but the purest thoughts, and send your hopes and dreams to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let me show you something I picked up on my vacation this year in Oslo, Norway, that may give us a valuable tip for investing. It's a mock street sign that carries the all-important message, look out for the elves. Elves, of course, is the name I gave years ago to all technical market analysts. And we have 10 of the best of them forecasting for us each week where they think the market is heading. A year ago, just to make matters even tougher, we announced that we would henceforth judge each of their weekly forecasts by where the market was precisely 6 months later. That means that we now can report definitively on their performances for the first 26 weeks of that year. To compile the ratings, we used a handy 100-point rule. The Dow had to have moved at least 100 points from where it was 6 months earlier for a call in either direction to be considered accurate. Otherwise, the Elves who voted neutral got the credit. By that standard, we have 3 clear-cut winners in the going so far. Leading the pack, if that's what you call a group of Elves, was Michael Metz, who managed to get the market's direction right in fully 23 of the 26 weeks, with tonight's guest, Mark Leibovit, coming second with 19 on-target weeks, and Ralph Acampora taking third with 16 winners. How did the index do overall? Well, here's the weekly record of the past year. By our long-standing rule requiring at least +5 or -5 for an outright signal, it gave only one series of clear-cut +5 buy signals in the 4 weeks from March 22nd through April 12th. The Dow was, in fact, higher 6 months after each of those calls by anywhere from 63 to more than 160 points, thereby confounding all the smart Alecs who were sure this would turn out to be a negative indicator, though only one of the 4 weeks would have qualified under the 100-point rule. Do I guarantee that betting with the index will prove profitable in the future? Heck no, my friends. Why, I'm not sure I even believe in elves. But judge for yourselves as we go over now and meet one of the best, tonight's special guest, Mark Leibovit. Mark, welcome back.
My pleasure, Lou. Thank you for having me back.
You're in good elfish company tonight. Mark Leibovit says there's nothing like a change of scenery to get the creative juices going. He credits his recent success in our Elves Index to his having relocated 3 years ago to Sedona, Arizona, far from the conventional Wall Street thinkers. Mr. Leibovit has published the Volume Reversal Survey newsletter since 1979 and is tonight making his 3rd appearance as my guest on this program. Mark, you're currently voting neutral in our index, which seems a popular vote. What would make you change in either direction?
Well, I really feel I should be still in the sell category. I got thrown off a little bit when the OTC comp broke out to new highs a few weeks ago. But most of the evidence is still a little bearish here, Lou. We have unfulfilled projections and volume work in Value Line, OEX, S&P that are still lower. We still have internal indicators. I don't want to get too technical, but like 40-day trend and McClellan oscillator still in downtrends here the last several weeks. And even though sentiment on a contrary basis would say, gee, this is a good time to maybe be looking for a bottom, those indicators are really saying that. For me, to answer your question, a shake to the 2700s, something like that would be encouraging, set up with some positive divergences in the indicators and make me feel a lot better.
Okay, now let me translate all that into simple English. Are we going up or down the next 6 months?
Next 6 months is a tough call. Right now, I'm neutral on the next 6 months. If we can shake first, I would say up. If we go up, I don't know where we're going. Volume slowed into the August 29, September 3rd highs. I don't have significantly higher projections in the market, so I would say we'll be at the same level or lower in 6 months with present technicals where they are. 2,700
is a not uncommon forecast because it's about 10% off the high.
Right.
Do markets usually behave in the way the consensus wants them to?
I don't know if it is consensus or not. I still think there's a lot of optimism out there. Everybody's looking to the presidential election year to bail us out, which is a big concern. I'm a little concerned what's going to happen after a presidential election year if everybody's so excited about it now. But 2,700 has been an unfulfilled number for several months in my work. It's not something that just was generated.
Do you have any unfulfilled numbers going up?
Well, I can rationalize the 3,150, 3,200. I mean, if you say if it broke out, where are we going, I could rationalize that type of number. But I think it's going to be tough to trade if you're looking to get in the market.
Well, it's fun to predict the overall market. People want to know whether they should buy individual stocks. And are there any individual stocks that look good to you at this point?
Well, that's been really the key. It's been a mixed market. You can be long and short, as you know. And I have a list here if you'd like me to take it out. But on the
Absolutely not.
Okay.
No, go ahead.
It's special situation stuff. This is it, scanning about 2,000 stocks, which is what I do daily. I'm hard-pressed to find 20 or 30 good names, and this is what worries me. Genentech I like. I think the stock's headed up to 39, let's say. A little stock, Rollins Environmental, REN, under accumulation, looks several points higher. I like a little stock, Fisher Imaging, FIMG, OTC. It's about a $15 stock. It looks like 20. Paramount Communications, way cheap, but also showing some accumulation patterns. Schlumberger is another name. Pier 1 Imports, Coastal Corp. These are special situations where I see volume flows, and they look interesting. But also, I would say on the short side, stocks like IBM, Digital, Hewlett-Packard still look lower. So I'm careful, and big names like that still look lower.
Well, with our usual caution that nobody bats 1,000, what's the thread here? Is there something about these companies that appeals to you or disappeals to you, or is it just their action in the market?
Just the action on a price-volume basis. They flash positive volume reversal, subsequent days of increasing volume. They're just special situations. I'm not saying this market's going to fall apart, even if we even go
Volume
sideways.
reversal basically means that there is greater enthusiasm when they move up
Exactly.
than when they move down.
We have increments of volume when they pull back, declining volume. And I'm not saying I've identified every one in my universe, but these are the ones that stand out.
Well, let's focus on one name that you mentioned negatively that is known to everybody, and that's IBM. How much lower do you think that stock's liable to go?
Well, on a price-volume basis, I have a projection about 87 from current levels. This whole run-up, which was on good news and expectations, and that's also part of my thinking, contrary thinking, where you are in relation to volume. Volume was negative on the way up. There was nothing in my work that said the stock had to go up. And when it came back here in the last week or so, volume increased back to the downside. So I'm not very positive on the stock.
Being a true elf, you don't care whether they make computers or videotapes.
To be honest with you, half the stocks I follow, I'm not really sure what business they're in.
That's also true of some of the CEOs. Let's turn you over to this sympathetic panel of elves, starting with Marty Zweig.
Mark, the bond market has been quite volatile this week. Do you have any opinion on the bond market?
I'm not too happy about bonds here, Marty, on a short-term basis. I have to emphasize that I tend to be more short-term and long-term. But volume slowed to par 18, negative volume reversal off the top, which was the high.
Par 18.
118, the high we saw last week. Volume slowed up there, negative volume coming off of it, increased again. Little distribution going on. If present patterns continue, we can see 95, 96. I guess you can argue with the Fed intervening, we're going to go higher ultimately, but volume right here is a little disappointing to me. Looks a little toppy. And also we've rallied from 92 all the way up to the 101 area, which is a little high, I think.
We should explain for those who think par means golf that you're talking about the Treasury bond futures.
Correctly.
Gil?
Mark, what about commodities? Are there any opportunities you see there for investors?
I'm very positive on crude oil. In fact, I'm actually long some crude oil calls for my clients and recommendations. We've been talking about this for weeks. We've been positive. I have projections of $27 a barrel, maybe 32 on the upper end. So something's happening in that market. And I have a high confidence in crude oil. Last May, for example, before the Iraqi invasion, anything was happening, we were putting out buy signals or talking about it. Higher projections were coming in. So if someone knew something was coming, or at least that was the interpretation you saw in the volume charts because it exploded. But I would say that looks like an interesting area. Also, copper looks interesting to me, too. Looks like $1.13, $1.15. It's trading around $1.03 now. It's been under a little accumulation. Stocks like Phelps Dodge and Cypress Minerals have been acting well.
Mark, a lot of us look at different theories in technical analysis. I know I look at a lot of price action, but I think you place more emphasis on volume. Could you quickly tell us why?
Well, I guess I've been spoiled because that was my training. We all have our guru figures in the market. I suppose Abe Cohen influenced you with point and figure, and I had a fellow by the name of Roger Cole, who was my great teacher, who was a volume man. But what I've learned over time is I've learned discipline. It's been successful. I've also learned that price, on many occasions, is affected by volume ahead of that. And the old adage, volume precedes price, certainly has worked out in many of my calls. In many instances, you'll see movements in price after volume comes in, and there are a lot of striking examples of that, like the crude oil I just mentioned. So I'm very biased, and I think it's a good indicator. But it's certainly not the only one out there.
Following on that, Mark, is your indicator just a relative volume indicator, or are you concerned that we don't have more volume of trading?
Relative, very important point. The same technique worked 25 or 50 years ago, regardless of absolute volume in the markets. As long as the stock is moving up an incrementally higher volume or down, you can get projections and get a good feel for it.
Now, two things you've said, in that you're a little bearish on bonds and you're a little enthusiastic about crude oil, suggests maybe a little blip of inflation. If that's going to be right, one of the beneficiaries might be gold. What's your forecast there?
Well, I'm not that positive on gold. The shares really haven't been showing the kind of positive divergence. That is, when gold goes lower, they hold at a higher level. I still think we're in a deflationary cycle for the past decade. I'm not really all that excited. And looking at the charts, there hasn't been any great accumulation. I think the move in crude oil and what's happening in bonds are independent events. I'm very careful, Lou, about tying markets together and saying because one thing is happening, another has to.
We have less than a minute left. You've given us a forecast which you've repeatedly emphasized as a short-term forecast. Some technicians take a very gloomy long-term view. Does your work suggest that that's appropriate?
I have no reason to be gloomy long-term. In fact, my own prejudice would be extremely positive on a bigger picture basis once we can get all this out of the way. When you see where the Dow is trading today relative to all the news and anxiety, I think if we can get a little shake, I think we're off and running. In fact, the little forecast model that I've created, this annual forecast model, shows a possibility of a strong rally in November. So on a trading basis, down and then up. But big picture, I think I'm still an optimist. I see no reason to be real bearish or concerned.
So that while traders might go in and out, those with a longer-term perspective maybe should be a little calm and stay with it.
I would say so, but I'm also concerned about where the economy is headed, but that's a fundamental hat, not a technical one.
In a word, where is it heading?
Well, if we don't do something dramatic with regard to creating some capital gains and interest, I think we have some problems.
Thanks very much, Mark Leibovit. Thanks, too, to this panel of elves who surround me. Hope you'll be back with us again next week. Then we will go in search of the American automobile industry's driving dream. My guest, Mary Ann Keller, is one of the country's top experts on the cars we drive and the companies that make them. So from Detroit to Datsun, you really ought to join us. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the Corporation for Public Broadcasting and by the financial support of viewers like you. By the travelers, over 40 million Americans benefit from our insurance investment services and managed health care. The Travelers. By Financial Guarantee Insurance Company, helping provide financial strength, security, liquidity. FGIC AAA Bond Insurance, tomorrow's security. And by Prudential Securities, the knowledge and resources you need to help make intelligent investments. Rock solid, market wise. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS.
WETA's local broadcast of Wall Street Week is made possible in part by a grant from the Johnston Lemon Group, parent sponsor of the tax-exempt funds of Maryland and Virginia.